Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 10th, 2012 edition of Market Outlook. So if you like this Market Outlook, you can sign up and join us weekly for this and go to the website www.marketgauge.com, or if you just want to see the videos, you can go to our YouTube channel also under MarketGauge. So this week, quite a turnaround from last week. As you can see here, we're on our www.marketgauge website, and there's some free resources which I'm going to refer to this week. One of them is Little Big View, which we're on here, and this is a great synopsis of the markets. As you can see, for the week-to-date change, we were up somewhere around close enough to 4% across the board. Overall, the recaptured being down for the year. The other thing to note is you get the accumulation distribution across four of the major market indices. And as you can see, we had a number of distribution days, and we almost had no accumulation days in certain of the indices until this week. But we did manage to put in a couple accumulation days, but most of this rally here has been on light volume. So not enough to really turn us bullish, but it certainly has eased off the very negative sell signal where we were having 4 to 6 distribution days. A distribution day is where you are down on the day with greater than average and greater volume than the prior day. So another thing I want to mention here is if you click on, there's a couple different pages within this, and this is 20 minutes behind, but you get a great breakdown of the market sectors, the leading stocks within the sector, and some pretty good volume analysis. So you can see all the stocks in the top groups. The group leaders are in this table right here. The contrary movers, the stocks that are down in the strong groups, in the bottom table here. One of the things you can notice is that our proprietary volume gauges, which is giving you real-time volume analysis based on the time of day, you can see that all the stocks in the leading groups, with the exception of NI Holdings, which is a communication services, was up pretty good, up almost 7%, only had slightly marginal volume greater than the normal volume that it would normally have based on a 50-day period. So you got a bunch of interesting information here. So that's the overall view of the market in terms of the performance. We're up about 4%. Leading groups were retail, some money-centered banks, gold and mining stocks took it on the chin this week. And so now let's go and take a look at the S&P, and there's some surprising things that we're going to go through today. First of all, the spiders. What happened? Well, first of all, you can see we had the bottom, this channel here, this channel line. We broke the 200-day moving average. It happened, you got two closes underneath, a close back on, negating the signal, all while attacking the bottom end of this trading channel. So what's happened now was with this rally up, we have now moved back into a strong warning phase. Why we're in a strong warning phase is that we do have a declining 50-day moving average. So we're looking for maybe some additional potential strength, possibly get up to this 50-day moving average, even penetrate it, and then potentially roll over. Now, on another positive note, however, you can see on our weekly charts that we had been trading under the 65-week moving average as of last week and the beginning part of this week, and we reclaimed it. So that is definitely a positive, although you can see it's sort of flattening out. On the longer-term analysis of the weekly trends, that's the 200-week, still strongly intact. So nice to have reclaimed that. So the potential impact is definitely an upgrade from where we were last week, where looks like we were under lots of pressure, potentially melting down. Of course, we're subject to news. So overall technical picture on the weekly charts markedly improved here on the dailies. Of course, as you can see, you did have an accumulation day or two on this move up. However, overall volume has been light. Take a look at the downside here. Huge volume to the downside. On this sell-off here, again, bigger volume. So this pattern persists where you have light volume basically on the rallies. It gives bears something to chew on. However, as you know, we had sort of that similar pattern all through the beginning part of this year, and the market managed to mount a pretty impressive rally even without the volume. So price rules, volume confirms. Oftentimes, yes, when we can get a good volume reading, it precedes price, but we have to be cognizant that the longer term picture with this light volume on rallies overall leads to vulnerability down the road. Now let's take a look at some of the market internals here. First of all, you can see the McClellan oscillator, which is good for looking out 1 to 3 weeks. Quite a different position from where we were over the last couple weeks. You can see with this rally, we're certainly no longer in an oversold condition, and in fact, we're working towards the upper end of average range. So again, that resistance around the 136 level in the S&P coinciding would coincide with an overbought reading of the McClellan oscillator, which is into intermediate term. So let's keep a close eye on this McClellan, see if we can get if it gets overbought, and again we need that confirmation to have it start turning down, and that would be pretty interesting and sort of consistent with the overall market phase, which is in a strong warning as that declining 50 becomes overhead resistance. And let's take a look at some of the shorter term indicators right here. Advanced decline, you can see not quite overbought, but certainly worked off its oversold levels. Definitely threw us off a little bit. It looked like with that decline, even the advanced decline and the up-down volume ratios barely sold off, but again, you had to have sat through some pretty significant price movement on the downside. But overall, if you held your ground, kept your overall view using these indicators, it definitely told you that the market was vulnerable to a correction to the upside. Momentum was definitely going to be petering out as the market internals were already indicating an oversold condition. But we're no longer there. So again, interesting as that 50-day comes down. If we have another couple days of rally, we're certainly going to be in overbought zones for both the intermediate and shorter term. So let's keep an eye on that. So right now, certainly more in the neutral zone and favoring some continued upside action. Also, adding to the bullish case is the fact that with this week's action, you had a situation where you were extremely, you had some irrational fear as depicted by the VIX indicator. We hit the upper end of the Bollinger Band, closed inside of it, gave you what we would consider a short-term buy signal within a longer-term sell. But what happened was earlier this week, we actually closed above the 200-day moving average as you got to that irrational exuberance level of fear over here, and it worked itself off. Now the market is in the middle or the mid part of the overall bands. So therefore, where we are is we've had a significant upgrade, a positive upgrade, based on the fear index, the volatility index here, because we're now under the 200-day moving average, which is our intermediate to longer term sentiment indicator, definitely turning more positive. we're attacking the 50-day. That, if we can take out the 50-day, we would be going back into a positive mode. So sort of on a short-term to intermediate term, 50-day moving average trend indicator based on the VIX gives us a overall bearish view. We've also worked off that short-term oversold condition in the markets as based on this. So I would say overall what we have in VIX is a definite improvement in sentiment. The fear has definitely subsided. So an upgrade, and let's keep a look at that. Let's watch this 50-day moving average, very, very important. That's at around the 20 level. We start moving down the 20 level, maybe we're going to get more of a rally than we expected. In the interim, the intermediate term, or that 50-day moving average, still indicates a level of fear and concern by market participants. Okay, so let's take a look at ITB. Now this is surprising because with a weak economy, you would think that the housing index, this is probably the most pure index for home construction. All right, this is ITB. We'll take a look at XHBs. So surprisingly, take a look at this. You got a situation where the 50-day moving average is now being attacked, and if we can get above the highs from Thursday, we can actually get a pretty good move outside and maybe a move to new highs. Now this is quite a bit different than the S&P 500, which is just starting to move above the 200. So the relative strength between some of the housing numbers, some of the housing ETFs and individual stocks, quite a bit different than the S&P. Now, if we take a look at the longer term trend, let's let me move to a different chart here, ITB, and let's take a look at what we're talking about here. Let's see. Let's move to a weekly chart, and so on a weekly chart on the ITB, the home construction, you can see that this thing really got smoked. Obviously led the market down during the financial crisis based on mortgage, home building sort of stopped. So we've been going sideways here. Now in the sell-off in the last month, and the recent recovery, you can see that we've got some sideways action here. If we can get above the recent resistance levels at around 16, you can see that this downturn in the housing relative to the overall performance of the S&P 500 is a big improvement. Now let's take a look at some of the individual home builders. Lennar, LEN. What I want to do is go to the, and again you can see doing pretty well on the weekly, quite a bit different than the S&P 500, right? We're trading well above the 200 week moving average, and I just want to verify that this is the 60. No, this is the 50. Okay, I'm going to change this to the 65 week moving average, which I like to use on the weekly charts. And you can see we're trading well above the 65 week moving average, which is this blue line. So some of the home builders here really starting to outperform the overall market. Looks like to me this bottom that has been traced out still very, very much in play. I know that there's an interesting pattern on the daily chart. Let's move to a daily, and what we're going to do here is change back down to a So as you can see, we're just sort of straddling. I'm going to change back here to a 50-day moving average. And we're just straddling that 50-day moving average in LEN. So if we can get a move above the highs of Thursday, we would then take out the 50-day moving average and start attacking the recent highs here. So this is overall in a much stronger position than the overall market. Look at the strength of that 50-day moving average relative to the S&P, which clearly had turned down. Also, let's take a look at Toll Brothers, another housing stock, and this one is even set up better than the stock that we just looked at, Lennar. Toll Brothers is already above the 50-day moving average, about to attack this 10-day, but more importantly, you are in a bullish market phase. You've got a basically flat to slightly rising 50. And also, please note, you've got an inside day. So if we can get through these highs here, the last couple of day highs, it will confirm a move out of a bullish phase, take out the 10-day moving average, and set you up for a potential test of the highs. So that's a wrap for now, and hope you had a great week trading, and good luck for next week, and look forward to seeing you at our next version of Market Outlook. And remember, please sign up to get this on a weekly basis at www.marketgauge.com or go to our YouTube channel to get these videos. Thanks, and bye for now.